Hello and welcome to this edition of All About Your Company. I'm Harsh Saita. Very quickly, we're going to continue to talk about real estate. We spoke about real estate on Friday as well. We're going to be speaking to a Mumbai-based real estate player today. Why is that so? Newly listed, by the way, this company, but immense amounts of interest during the IPO. IPO was oversubscribed nearly 75 times on the issue itself. It's around 7,000 crore in terms of market cap. It's asset-light luxury real estate developer, and Sri Lotus, it has a concentration of sorts within certain geographies in Mumbai. There's geographic preference as well, and they do ultra premium projects. That's what they do. In terms of just the pricing since listing till now. That's what you're seeing on your screen now. IPO to now, the stock is down. But nonetheless, the IPO happened at around 150 rupees a piece. The listing price was 179. It went up to nearly 200, came off, and that's currently the play. Over the last 6 months or so, the company has given a negative 25% return. That is since listing nearly. And in the last month or so, we've seen a jump up in the stock price of 17%. Really, that's what's standing out for me, that we've started to see a jump up. And with everything that's playing out, it's going to be interesting to see how this one evolves over the next few years. The other and the key piece of news that came out over the course of last week was that they've launched 11 new projects in coastal Mumbai. Now, this is a significant addition to the already strong portfolio that they have. 14,000 crore of GDV is what they currently have across the Mumbai market as well as across GIFT City. That's something that they already had prior to this launch. 8,000 crore in residential, 5,500 crore odd in commercial. That was the broad split of that 14,000 crore. And the PAT margin that they're penciling in over the medium term is 25 to 30%. So they have very, very strong aspirations both in terms of profitability and growth going forward. That's why this looks interesting. Now let's look at the company itself. I'll give you a quick top down. One, it is promoted by Anand Pandit, who is the promoter currently. The promoter family owns around 82% of the company currently. It was incorporated in 2015 and it's a Mumbai-based luxury, ultra-luxury realty developer. In terms of the products that they do, no surprises here. Luxury residential, premium commercial is also what they do, and facility management services. They operate under the Lotus brand, and they're more into redevelopment and joint development. That's really the focus area of the business. And therefore, let's look at the business model itself. The project selection is based on blue water or garden view. So there has to be a good view that the luxury project that they select provides to the buyers of the flats. Second is there is very limited land buying that they do. They don't do too much land acquisition. It's generally through joint development or through redevelopment. I spoke about this. Or there is a profit share pact in place. So they don't do too much land buying. Only in exceptions do they do that. And then they do end-to-end in-house designing construction services. That's broadly already built in. They also do luxury residential development in apartments across Western Mumbai thereafter. And then there is conversion of those through sales, marketing, customer support, and facility management. And then what we've started to really realize, or what they're proud of, is that there is a 20% ballpark premium on a per square foot basis that some of their projects command over peers in the same micro market because of some of the factors that I listed above. The fact that there is a premiumization in terms of the way they present themselves. In terms of the geography, largely the Mumbai micro market is what they focus on. Mumbai western suburbs, GIFT City. In terms of the core micro markets, it's Juhu, Andheri West, Versova, Bandra, Prabhadevi. They also have a new project now this time around at Nepean Sea Road. So that also coming up. And GIFT City, something around 2,000 to 2,200 crore in terms of the development there as well. Gross development value likely to come through over there as well. So that's broadly the take. it also prides itself in closing the construction much prior to the RERA deadline. Sometimes 18, sometimes 24 months prior to the RERA deadline is what they pride themselves in. And that's the other niche that they've culled for themselves. In terms of projects, let's take a look at the list. Ongoing is around 6, upcoming is 14, and this excludes the recent 11. This is as of Q3 data, which I'm just presenting right now at the end of Q3, right? So ongoing 6, out of which 4 are redevelopment, 2 are joint development. In the upcoming 11 are redevelopment, 3 are joint development. In terms of commercial, there are 2 completed and 3 upcoming. So there is a pipeline there as well. In terms of GDV, let's quickly take a breakup of that. Residential is around 8,000 crore, 5,500 crore commercial. This is ballpark that they've disclosed. In terms of new projects, there are 11 new projects which have been launched. This is the latest development that's come through. That's broadly the areas that they've covered in terms of the locations of the new projects. 11 new projects, no GDV disclosed. We'll speak with management and get a perspective of the kind of GDV potential of these projects. Now, let me talk about the last 3 years' data, and off a very, very low base, mind you. Look at the top line in FY22, 88 crore. Currently sitting at 548 crore. In fact, trailing 12 months is even stronger. In 9 months itself, they've done around 460 crore in terms of top line. So the trailing 12 months will, or rather the FY26 numbers will be far stronger. 84% growth CAGR. The guidance continues to be that kind of a range, around 70 to 80% kind of top line growth is what they continue to pencil in even going forward. You look at the margin picture, EBITDA has improved dramatically as scale has come through, obviously, understandably, and EBITDA has grown at a CAGR of nearly 200% every year. And therefore, from that very low base of 12 crore, EBITDA is currently standing at nearly 300 crore. Some one-offs in FY25-26 within that EBITDA number as well. And that is because of a COVID land acquisition that they had made, due to which you saw a huge unwind in terms of value happen on the EBITDA front in FY25 in particular. So that's a slightly elevated base in terms of EBITDA. Third, and by the way, we'll speak about margins as well, but you look at profitability, very, very sizable jump in FY25. I explained that jump to you, but 200% on that as well. In terms of margins, and we look at that, margins spiked as a result of what I just told you in FY25. Thereafter, it's come off very sharply in 9-month FY26. That's the 9-month FY26 number of around 34 to 35%. But that's ballpark where the margins will lie, is what management's aspirations seem to suggest. So that's broadly the way in which we're looking at the business, both on the, at least on the P&L front. Let's look at the balance sheet now. Fresh issue of shares, and due to that, that's the 9-month numbers. But the balance sheet now, you're looking at around 1,800 crore of book value at this point. Borrowing is very, very low. And they've got a cash balance of around 1,000 crore at the end of H1 FY26. At the end of Q3, a net cash position stood at around 800 crore. So there's a very strong net cash position that they continue to have. So the balance sheet looks robust in terms of poised for growth. No concerns there. The balance sheet ideally should be a thumbs up. No reason to keep that as a neutral. Let's look at cash flow though. Cash flow is where the conversion is always chunky in real estate companies, and therefore not exactly the right method to see, because collections come on completion and generally projects are taken up, and thereafter as completion or as percentage of completion unwinds, cash flow does come through. So that's how cash collections work here. This is something that you should know, but broadly negative cash flow because of inventory built up that's happened. FY25 at least, FY26 that should unwind in terms of positive cash flow. Let's look at return ratios, and return ratios have spiked sharply, as would be understandable. FY25 was a standout year in terms of profitability because of what I did explain in terms of the margin lift, and therefore you're seeing a 37% ROC at the end of FY25. But that will come off. It's a high base that's playing at. In terms of shareholding pattern, 82% held by promoters, 2% by FIs, 3% by DIs, the balance held by publics. Some amount of divestment by promoters may be required to meet minimum public shareholding. While it's a thumbs up because of the very strong nature of the promoter holding, one, but second, it's also the quantum of interest that the IPO garnered, and as a result of that, we've left that thumbs up as is. that hopefully as they dilute their shareholding, it should not impact overall the stock price or the returns, and therefore we've left that as is. In terms of valuations, and this is where it holds the key, 30 times is what the multiple Lotus currently gets. That's on a trailing 12-month basis. You're seeing some of the other peers also trade in a very narrow band of 25 to 33 times earnings, and you can see that on your screen. Lotus trades at 30 times, so broadly in line with peers. We'll try and get the GDV metrics, but currently at 14,000 crore GDV plus the 11 projects, we'll get a sense of how much is the GDV versus the market cap. Because for a lot of the developers, GDVs have just run away very, very sharply. They've run up. Of course, Sri Lotus seems to be catching up on that count, and we'll get a sense of exactly that. In fact, let me bring on board Mr. Pandit, Mr. Anand Pandit, to give us a perspective of exactly that. Mr. Pandit, great having you. Let me first start off with getting a perspective of these new 11 projects that you've launched. What does it mean from a gross development value perspective? What's the value of the 11 projects broadly that you're looking to achieve? And the timeline is 4 years, is what I understand.
Correct. First of all, thank you for having me on your show.
Great having you, sir.
This 11 project, depending on market rates, it would be between 8,500 to about 10,000. Between that, the GDV value would be. What we have done is, we have created a sub-brand of a company. It's completely new concept. Rather than project level, we started making a brand around our theory. Our theory is B and G, that is blue and green is our theory. Wherever the water is there or garden view is there, only those kind of properties we are buying for as far as luxury residential is concerned. So we have right now mounted about 11 projects right on the water, starting from Warsaw to Nepean Sea Road. All these are residential projects. So we thought that we will club all this as a sub-brand called Coastline Luxury Collection. And this is how we try to position ourselves. Like in so many other countries also, people have done with 2 or 3 projects like this kind of collection. And as we know, whenever there is any residential, particularly residential project right in front of ocean or water body, it's considered to be very, very premium or very, very luxurious. And this was our concept. Out of this, about 4 projects we have done soft launching. 7 we would be launching this within another 4 or 5 quarters.
Okay, so yeah, that was going to be my next question. When does it launch? Okay, so these 4 projects that you've launched, in terms of approvals, where are you placed? Are you comfortable with the kind of approval timelines that you have? Because your completion timeline is 4 years. I'm trying to get to the fact that whether you'll complete it prior, which has been your track record.
So as far as these 4 launches will be, before the time we will be completing, before our RERA timeline we'll be able to complete it. So not a worry, because we have got complete full approvals in place, and that is how we launch it. So that's one. Number 2, remaining project, about 6 to 7 projects, more or less we have achieved about 80% of our approvals. Every project, 1 or 2 last approvals are remaining, and we are very hopeful that in 3 to 4 we'll have all the approvals in place and almost all the
Mr. Pandit, I believe I have you on a very patchy line, but of course you seem extremely confident with regard to the fact that you're going to complete those projects well within the RERA timeline. Mr. Pandit, I want to quickly also touch upon the fact that you've won 11 projects, which is a large number. What's keeping you ahead of competition in areas like this, especially when you have projects on a redevelopment, joint development, where the capital required is also low? Why aren't others participating, or what's keeping you ahead of the curve?
So our focus is, because I personally consider number one, real estate business and redevelopment business is completely different. We are experts in redevelopment. Our business is only redevelopment. So 95% our projects are redevelopment only, society redevelopment. So number one, uh, when society chooses their partner, they see that what kind of legacy the developer has. And we are proud to say that we have done maximum numbers of execution of redevelopment. Also, redevelopment we have done in ultra luxury space. All these redevelopments generally people do it in only premium category, but we have done in ultra luxury space. So that is how we are ahead of the curve. And third, our execution timeline, as you know, we have always done much before the radar timeline. So these are the three main things. Also, the company is completely net debt free. So that burden also is not with us, and that is really appreciated by the society when they choose their partner. Uh, and particularly on the ocean, I don't think any other competitor has got so many 11 redevelopment project on the ocean. And we are very proud of this, our recent launch.
Okay, yeah, I get your point. Mr. Pandit, what's the sense with regard to new launches from here? So of course, these 11, out of which 7 will eventually launch, 4 soft launches have already happened. But talk to us about more projects that you're looking at. Are you going to take a pause now, focus on these 11 that you have on your hand, or if opportunities were to come up, you're still open to taking more? What's the sense like, and are you expecting more to come in FY27 itself, or you're done for the year?
No, we are we are adding our pipelines continuously, and all these 11 projects which we have mentioned, all are completely streamlined. So there required paperwork and required planning. Everything is done, and also the financial tie-up, because it would be internal accrual and some from our sales. So we don't need external financing. So in a way, it's completely tied up all this project. So for the future pipeline, we'll be definitely adding many projects this year.
Understood. So more to come, in fact. So very robust in terms of the outlook. Talk to us about the margins on some of these projects. You've ventured into slightly newer geographies within the Mumbai market, of course, well known to you. But are the margins materially better? Are you expecting margins to come off? How should one look at the margin picture on these projects? Or will they be in that guided range of approximately 40% for you?
So our guidance was about 40%, 40 to 45% EBITDA margin. I think we'll be able to achieve that. And our net profit margin, we said between about 29 to 32%. That also we are very confident to achieve it. So last year, our per square feet revenue was about 60,000 rupees. Now, since we have gone to other micro markets, those are more high value markets, I think we'll increase our per square feet revenue, and that will lead to have better EBITDA margin also.
Mr. Pandit, you were expected to have a materially stronger Q4. I'll shift focus to the company as a whole and the glide path going forward. You were supposed to or expected to have a materially strong Q4, and your guidance in terms of top line for the foreseeable future is approximately 70% odd, which is extremely strong. Talk to us about the sustainability of that number, and if at all you can, give us a hint on Q4. Have you been able to touch the kind of numbers that you were looking to touch?
I don't know whether I'm allowed to say that, but whatever we have promised for our pre-sales guidance and other guidances, we'll be able to meet all those guidances.
Point taken. And with regard to FY27, sir, so on this very elevated base, say on the 550 crore base of FY25, you clock your growth for FY26. Talk to us about FY27 and beyond. Can you grow at this kind of 70% clip, and if so, for how long?
So we are very confident, I mean, market is for ultra luxury market is just getting developed, I would say. And we have always worked into ultra luxury only. People who are in premium category right now, they also want to move to ultra luxury. So it's like a pyramid. We are sitting on the top of the pyramid, and that top was very tiny, and now that is getting expanded. So as far as our basket of client is concerned, our business is concerned, is going to expand in totality for everyone. And we'll be, I think, enjoying a large pie of that. So we are very confident for next few years, easily.
So a 70% growth, is that realistic? Because you'll say you, I'm just taking ballpark numbers. Say you do 700 crore, 750 crore of top line this year, conservatively. You'll likely have to do around 1200 to 1300 crore of top line next year. Are projects ramping up in that fashion for you to be able to get to that kind of a number?
So as far as projects are concerned, we have locked those kind of projects also, and we are adding those projects. But looking to the nature of business, where we are quite dependent on our approvals from the authorities, at times, whatever we might have envisaged, we may have to shift that to the next quarter. That's the only difference it could have. Otherwise, yes, we will be able to match that.
So a quarter here or there, but broadly you'll be there on a trailing 12-month basis. And that growth will be extremely impressive, because if you do 1200, 1300 crore of top line, Mr. Pandit, you'll likely do around 300 odd crore of profit, which will mean which leaves you in a very strong position. In fact, 400 crore of profit, if I'm not wrong, because 30% margins. So that'll leave you in a very strong position in terms of even the multiple that you're giving your investors. But give me a sense, Mr. Pandit, last off, you have a large chunk of cash lying on your balance sheet. How quickly do you go through that? How quickly do you utilize that? And for the kind of growth you're doing, do you take on debt and on the balance sheet at all?
So till today, we have not taken any external debt. It's so, as I said, company is net debt free from beginning only. Our model is so robust, as far as financial model is so robust. We are like completely asset-like model we run on. And as you know, in redevelopment, generally what you require is just the 10% or 20% of the project cost. That's the only thing you require. But simultaneously, you will be able to sell your material also. So you don't require much cash for your business right now. But yes, if it is required tomorrow, we are very open for equity route or a debt route, both. But I don't think we'll require that, because next year our profit also will plow in. Then second year also we'll have another profit also plowing. And we have made those numbers, and I think we won't require external debt.
Okay, so no external debt required. You have enough cash on your books to take care of the kind of expansion that you're seeing. Thank you so much, Mr. Pandit, for coming in and speaking with us. Viewers, if this were to go to, say, 1400 crore in terms of top line, say FY27, broadly, of course, we'll have to await the FY26 numbers, at or even 1300 crore, for example, in terms of top line at 30% PAT margin, that will likely mean 400 crore of bottom line profit. And at 6800 crore, that means around 17 times earnings is what this one trades at 1 year forward, if that all of that were to obviously play out with a large growth perspective or prospects going forward as well. All the time we have on All About Your Company. Thanks so much for tuning in. More action on the other side. Stay with us here on ET Now.